Well, let's get in a view on the markets, the road ahead, whether or not we can see this kind of momentum continuing as a V-shaped recovery on the cards, as well as what is the outlook on the new fund offer from HSBC. Well, we've got Neelotpal Sahai. He's the head of equities at HSBC Global Asset Management. Thank you so much for taking time out. So much to talk about. But first, I'd just like to touch upon the overall market. And we were talking earlier this morning whether or not the kind of enthusiasm and euphoria that we're seeing across the globe can continue to stretch itself, or whether or not we are going to come to a fag end of this rally, not just in India, but across the globe as well. What's the sense that you're getting, and what do you make of the kind of levels that we're witnessing right now?
Sure. Thank you. Thank you for having me on the show. So let's first try to understand why the market has been rallying after declining in the month of March. And the primary reason for that has been that market began to look ahead for the forward data of the period of opening up. So after the complete shutdown for the month of April, from the May onwards, when we began to open up, then instead of looking back at the economic data which would have come for the lockdown period, that obviously would have been very weak. But a market began to look ahead and began to look at the period when the economy would have opened up and how the data is looking forward. And on that count, market began to track a number of activities on a week-by-week basis, month-on-month basis. And there has been improvement, gradual improvement, but nonetheless improvement on most of the parameters. The second point is that initially the monetary stimulus which the central banks had did have an impact of calming the markets. But later on, especially the developed markets, because of the bond purchases that have put a lot of liquidity in the market, and which is now chasing the higher yields. And that is also has helped in the FII flows to reverse, which was negative in the month of March, flat in the month of April, but a significant positive in the month of May and June. Now, also what we see is that on the pandemic front also, the kind of understanding which market has is that there won't be any second wave. We have not seen that into many other places. And even if there is one, the economic impact would be limited. And which is why the rally in the market is there. Now, from here, for the market, what it is actually factoring in is that there would be an improvement in the economic output and hence a recovery, but a slow one at that. But at the same time, it is also factoring in that an inflation would continue to remain weak for an elongated period, and as well as interest rate will remain low. And to that extent, those are also supporting the valuation construct. And we don't have a problem with any of these forecast or the assumption that the market is making. So at this point of time, one does believe that the risk and reward is kind of balanced. On the valuation metric, on the earnings related valuation metric, market may have peaked and gone higher than the average, but on many other metric, it is still okay. And that is why I say that it is kind of balanced from here.
Fair enough. I just wanted to touch upon then the NFO, that's the HSBC equity fund and focused equity fund rather. Can you give us a sense as to what is going to be the overall sectoral thrust and what is the outlook here?
So firstly, the important point is that it's going to be a focused fund. And the reason for that is that a trend that we were seeing for some time was that there was a polarization of profit within many of the sectors, and it was happening on account of the disruption in many of the sectors in the past 2-3 years. In the past also, similar trend has been seen that after disruptions in the economy, there has been a polarization of profit. So when the pandemic happened and it is having an impact of many sectors at the same time, and which is unprecedented in a manner, and thus it is impacting a number of sectors. So we thought there would be polarization of profit in many sectors, and that will throw up a number of ideas. And in order to benefit from the many new emerging themes and the ideas, that we thought a new fund and a focus fund at that would be the best option. Now, within the focus fund, our thought process is to have looked at the dominant players in the east sector, which would be where the profit pool would be migrating to, or from the weaker players in this section, and to look for if their profitability can be sustained for a longer period. So that is what we are looking for. Now, from the medium term, also a number of opportunities has been thrown up on account of the pandemic, or even without that for that matter. For instance, there is a higher digital adoption by both consumer as well as by enterprise. Now we believe that this particular trend can continue further, and it can become normal in day-to-day life also, which means the businesses and the enterprises in the business of providing a service on discounts, actually they are going to benefit for a medium to long-term period also. An additional theme and the trend which was also ongoing but now probably will accelerate is the fact that the investment in the global supply chain that was diversifying. Initially, it was a China-centric global supply chain, but for last couple of years, and now after pandemic, this trend will accelerate, that a number of corporates and the countries will want to ensure that their supply chain is more diversified. And as a result of which, India also one of the countries to compete for these investments. And we believe that some of the sectors in India are in a better position to attract. For instance, it could be specialty chemicals. So that could be another idea. However, if I look at the near term, then our thinking is that there are certain sectors which has already reached almost 100% of their normative sales, although some of the sectors are lagging behind. So there is a higher earnings resilience in certain sectors, those in the business of providing essential goods and services, healthcare, maybe telecom also. So those would be the primary choices. And the ones where the normalcy would return later in the year, or probably some of them will come only in the next year. So those would not be our choices at this moment in this one.
Do you think it's advisable now to look just beyond some of the marquee names within the frontliners or the large caps, and even expand horizons, really look at quality names within the broader universe, particularly within some of the sectors as well that you flagged off, because you did say that there are several opportunities in the market in the medium term. So what's the advice when it comes to dipping into sectors within the broader markets?
So let's not focus on the only capitalization. And my sense was to look at the dominant companies in the respective sectors. Now, the sector itself is small, and there are many such sectors where the sector itself is small, or the dominance would be in a particular location, geography, particular product category, or maybe for a molecule also. So that can also sustain its profitability. And those would be from the broader market, not necessarily in the higher market cap category. So when you're looking for an ideas, then we have to look beyond the top names, the large cap names, but we should be focused on the dominant names in the respective sectors.
Okay, so looking at the more dominant names in some of these sectors as well, when we look at the kind of recovery that we've seen so far as well, Neelotpal, it's been largely on the back of perhaps a rural recovery, or companies that are coming back to pre-COVID normalcy in terms of operations, or inching back closer to that at least. Are you still concerned with regards to the urban revival? Are you looking for further reports or indicators in terms of data, or are you convinced by what we're hearing so far?
Right. So when you look at the rural economy and the urban economy divide, so we do see that rural is recovering faster. Is also account of the better monsoons that we had last year, and expectations is better this year, normal this year. At the same time, we also realize that a bulk of the fiscal stimulus that the government is providing is going into the rural economy, and that also would be helpful in keeping the demand intact. And that's possibly are the regions that the rural is recovering faster. When it comes to the urban recovery, you're absolutely right that one would be waiting for more data points to come actually, and which is why one is actually tracking data on a week-on-week basis, on a month-on-month basis, to see even a gradual improvement which is there. But when one is looking at the company from the investment perspective, then one need not only be focused on what is happening right now, right here, and one should rather be focused on what a normal 12 months will look like and when will that normal 12 months begin. Now, if that were to begin, if, for instance, if the data, current data shows 70-80% of the normal sales, but it's likely to go to 90-95% in a couple of months and maybe 100% by the second half, then a normal 12 months for that company will begin from the second half onwards. And then from the valuation metric, especially the earnings related valuation metric, we should be looking at 1st October to next year 30th September to get a better sense. For some other companies, it could have already started even in the urban areas, especially in the FMCG categories, some of the healthcare categories, telecom sector, in tractor sector and others basically. So for them, our normal 12 months has already begun and this period can be looked at. But for some other sectors, especially capex intensive sectors or the labor intensive sectors, where the normal 12 months will probably begin much later. There also one is tracking data and the data is actually quite low even at this point of time. Even after reversal of the reverse migration happens, and even if the capex push is there, we still think that that will still take some more time for the normal 12-month period to begin. And which is why we're a little hesitant at this point of time to get into those sectors. But you are absolutely right that we should be looking at data more closely and then go for that actually, those sectors and companies.
All right, Neelotpal, thanks so much for joining us. We're going to take a quick break here. Do have a good day going ahead and hope to speak with you again soon on the kind of macro market disconnect we continue to see and how it evolves. A quick break, back in just a moment.